All right, hello everyone. This is Niaz again. Been some time since I've been making any of these videos lately. Basically with the market acting like the way they have done. It's been kind of like my bias, that we're gonna see some kind of a rally into the summer, and we have. However, is like kind of like how should I say, testing the limits, so to speak, of my expectation of what a uh, bull market should have taken and how would have taken. It's been or a summer rally that is, and the way it's moving up is just like consistently. Lately, the price action has been to the upside without any kind of like making any kind of base, and so that is a something that we're gonna go over. But yeah, one of the reasons is because like in my Twitter account, I've been under attack by all these Ukrainian simps basically, and yeah, they mass reported my account, and so now I'm kind of locked, and so partial one of the reason I haven't been doing anything. So anyway, so let's go ahead and um, let's take a look at the market. So basically, I think last time I did it, was it broke right before it broke like the 41.75 level. Let's go take a look. Let's see. Okay. Um, okay. Now my expectation back then was we should see some kind of a break at 41.75 and then about 42.90 or so, because those were the two levels that were important, which is, as I've shown before, like you have this 42.90, which is where it's has been kind of punching around that area right now. So we are gonna be facing quite a bit of drama here. See where it takes us. Um, but the main thing we were looking at was the 41.75, and even though with Powell and his speech, um, what ended up happening was the market was kind of looking um, like right over here you have this kind of like upside the inverse hammer basically, which usually, again, I don't really focus too much on like individual like bar patterns and stuff like that, but with Powell reiterating the same thing and all that, I was like, well, that was a good sign, right? um, and so basically what happened is, here, let me create a new. Okay, so basically what happened is that due to, I think I've gone over like part the reason why this has happened is essentially I throw a comment that they're going to be data dependent again in the future if everything kind of goes according, all the numbers say, and everything goes according to plan, and they're going to be basing the decision not now, at least in the future, not now based off of some kind of like a premeditated objective, right, of controlling inflation, but more to be data dependent. And you know so that's basically where the market took that as a sign to basically price in an upward moving market, number one. Number two, because now we have some give, because the Fed has deviated from their what they have been saying, that they're like hawkish, right? And so it's like you get, they gave the market an inch and everyone took a mile out of that. So what happened is, but since then, they have been running all the different Fed heads from all the different Fed banks, and they all been saying, no, 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 you don't understand. Like, I mean, we're still the same, right? I mean, we were still on a hawkish path, and with CPI did come down by like zero point 0.6 basis points. It was expected to be 9.1. It came out to be like 9. let's see, 8.5, and there was a really good print in job numbers that like blew it out of the water, so to speak, last week. New jobs were expected like 260 or something. It was doubled at 528. Now, if you look internally, it was basically the that was due to the public sector, in other words, the government hiring. And so let's look at this month. What the hell? Whatever, custom. Let's do custom. Um, okay, so mhm. Okay, there you go. All right. So basically, what happened is that the market took that as a good sign because, well, the health of of the economy, so to speak, is good. But with lower inflation, primarily they were looking at that as a way to infer that, with at least lowering inflation, that we're going to be the Fed will have more leeway not to hike rates. The problem with that is obviously that they're still at whatever 8 point something, right? Let's look back on the stats. Okay, I'm gonna show consumer sentiment also went up. Core PPI went down, which is actually something that's going to be more important to look at is the PPI numbers because that precedes actual CPI numbers. Uh, there you go, CPI. There you go. Okay, there you go. Inflation rate. Um, so they're going to be watching that like a hawk, right? And but the problem with that is that the Fed's goal is that this is something that their mandate is um, theoretically to keep inflation at 2% around, um, and with a leeway of like a neutral rate of 50 basis points. In other words, that nominal rate, whatever it might be, the neutral rate is basically you look at whatever the nominal rate is, add 50 basis points to it. So theoretically, they should control inflation at 2%, and with the neutral rate being 50 basis points above, that would be 2.5%, right? But the thing is, with the inflation rate at 8.5, I mean, even though it's an improvement, right, relatively speaking, people are pricing a whole lot of like good news out of that because the thing is that we're still at a high inflation rate. Now, a lot of people would say the futures market and the interest rate market is predicting inflation of like 3% or something like that. It used to be like 4%. Now it's down to like 3% or so. This time next year, late next year. The problem with that is that they haven't really predicted that well all the things that has happened till now. And this is again, future prediction may not come true. However, the thing is, even if you were to go to that, 3% level or 2% level, the Fed at this point has to do something in order to control that. And if the futures fund rate is still going to be Uh, Basically, something like let's take a look. I mean, it has come down a little bit, but let's take a look. So basically, I mean, you can see right now the where the expectation is that the Fed fund rates to be somewhere in between um, 275 and basically two spot 75, right? And then going into next year, we're looking at midpoint about 3.5 to on the Fed fund rate. So we have a situation where they are still expecting the interest rates to be jacked up higher. So this is still a contraction or a financially tight environment, right? Because also remember that they have barely started to do um, quantitative tightening. So yeah, let's take a look at the Fed and what they got going here. So in other words, basically they want to tighten about something about $3 trillion worth. And so they've barely gotten started doing that since like June. And you can see the total number of assets hasn't gone down that much, right? So something about like roughly 200 billion. What it essentially does, it um, takes away liquidity from the system. So that way there's simply less kind of money going around, so to speak, to the economy, that way that controls for inflation, because runaway rampant speculation, with all the cash out there, that's what provides for asset price fluctuations, asset price increasing asset prices. So basically, that's where we stand as far as where we think that the macro situation, everything's that's being driven by from the perspective of interest rates now or inflation. Now, the expectation also is that a lot of people would think that the inflation rate would just like drop out of the sky, like it'll go from 8.5%. Where did it go? There you go, 8.5% to like 2%, or whatever the market is expecting. Which again, like I said before, nobody is expecting, and including like the futures market or the interest rates market, that we're going to be hitting 9.1 or whatever. I think 9.5 was the top we've seen in inflation. Um, which again, that goes to show to you always take things with the pinch of salt, so to speak. And so we're not really out of the woods, and this is without saying that with this kind of a tightening situation, what kind of a impact would it have on earnings, right? And what does that imply for the situation where these companies are going to be making money? The answer to that is, well, basically it's going to get worse, and that's the next leg hasn't dropped it 100%. Now, my expectation was that we might be seeing worse numbers or significant worse numbers. That hasn't happened. However, there has been revisions and guidelines that has been kind of like Walmart, saying that basically people are not, they have excess inventory. People are not, but they're expecting 10, 12% less revenue in the future. So those are signs that essentially, people are not buying and think things are kind of slowing down, right? But this hasn't really caught as much, like that they haven't been coming out with all kinds of rapid amounts of like downward projection. However, though, it's coming out, and this is something that's going to happen like in a drip, drip, drip fashion. And when the market, this is again the projection is that we're living and we're working through a financially tightening situation where as things become more tight as basically banks or the companies have to service the debts at ever higher level interest rates, right? Ever like cost of business gets to be more expensive, especially with companies with a higher amount of debt on the books. What you have a problem or situation is that it gets tougher for them to make do business and and be profitable. And so that should have a downward effect on their bottom line and on the earnings. And if S&P, like I said before, some other videos, that S&P in this kind of situation, we should expect S&P's earnings to go down, right? If that happens, then S&P should, at least on an earnings based basis, valuation, just a napkin, back of the napkin type of projection, should go down if the earnings go down. Now that leg, it's something then we still should be expecting in the future, because for that not to happen, our underlying condition in the market or the economy is to be, that we should expect, um, as long as we live under the same kind of environment, right? We should expect that development, because that's the next leg of the development, and which would mean that our expectation of the market should go down, right? Or at least to the downside. That's the bias. Now, technically speaking, one of those things that I said the last time, that 4175 was an important level, and that was before I made my last video, and so it touched it, went back down, and blew up again. Um, Now what's funny is basically we went up real quickly to 4290 level. It hasn't gone up yet, but maybe let's see if it kind of slows down here. What happens now? Something important to see here is, now we're hitting up to the 200-day moving average. Let's see, and simultaneously you have this kind of a resistance line that you can go from the all-time highs of 48.18, touch that next pivot high, lower high at 46.33. Now it's almost like they're converging. Both the 200-day moving average and that line is converging. And also remember that on a pivot level or horizontal level, we are at 42.90 and we're still hanging around that. So whichever side it breaks, this is kind of like going to be an important level, technically speaking, as it said before, um, because this is shaping up to be an important area where the market has to prove itself. Till it does, technically speaking, at least this is not a, this might move the technical nature of the market. Now look at the way the market's been moving up. It's just like straight up, right? Which is kind of disconcerting, because most people say, well, it's just moving on up. But the thing is, yeah, I mean, short term, you can play any trend, and this is what I'm not, the more the merrier. If it makes money for you, great. In fact, that's what I do, right? Nowadays, I don't have a lot of time. I'm not trading 100% like, full time, like my old job. But I'm still, dabbling whenever the market's moving and the market's about to make a turn and stuff like that, like I've been doing, right? However, though, if you look at the way that the market's moving up, it didn't take a breather, didn't do a consolidation move up, and it just went like a V-shaped kind of pattern move up. Now, this doesn't usually happen, right? Just like I said, that kind of going back to the inflation rate. I mean, even if you go for inflation rate of 8.5% to 2%, it doesn't happen overnight, right? Usually what happens is that there's a spike and it comes off a spike, but it settles somewhere. It doesn't stay at that elevated level for too long, so inflation rate doesn't. It's not going to set 9.5, but they come down to 5 or whatever, right? Let's say it come down to 5 or 6. Well, the Fed still has to work its way to make it go down to like the 2% level, right? The same way, which is actually again a reason why I think that this is just projection, kind of going back to the interest rate talking point, that the market expecting them to like start to hike less, or start to like ease again, and it's just because unless they take action, it's going to be hard for them to control inflation. And so if that means that that there's still like quite a bit of hiking to do. And so when the market kind of takes note of that, we might see another leg down. Now, what's interesting here, to kind of going back to from a technical perspective, is that um, on a bear market, you don't get like this kind of a V move up. You kind of see some kind of a basing before it moves up, right? Um, and so this is this even though it looks good and does, technically speaking, it hasn't done that kind of a work to create a good base to solidly move up from it, or have a good area of basically buying activity before it went up. You can see that there's a lot of volatility in the low end, on the bottom, close to the bottom, and then just shot up. Again, that goes to show there's been a lot of internal, kind of not a lot of like accumulation, rather than like wild gyrations, wild trading. So that's technically, again, the basis of it is kind of suspect, in my opinion, or at least there's reasons to doubt from that perspective, from based off of historical precedents of like bear market price action. Okay, so now where we are at, though, it is technically an important area, and then the next one up is 45.24, and then 46.33 or so. But I think this is going to be an important area. Now, like I said in my last videos, that if it does break through, I mean, we are in a sideways market technically, but we're still going to be in a bear market overall, till, because the bear market is what, based off of our underlying market conditions. If that's, we should still have a downward bias. Intraday, short term doesn't make any difference, but in the intermediate to long term, like 3 months to year out view, we're still, unless underlying conditions change, we're still looking at a bear market, or bear market situation, or market environment. So now, something to also take a look at is few of the technicals. You look at the market internals, and I think that's kind of also interesting to see what that might mean in the market, and where it might be headed, or kind of tell you the underlying strength or weakness of this move. Let's see. Let's go to advancing declining issues. So this is basically going into the number of stocks that are going up or down, like on a daily basis. So it's like takes a look at the number of stocks that went up in New York Stock Exchange versus the ones that went down. And so again, the funny thing is that if you look at it, even the market's been going up higher, they've been trending really, especially in the last few days of really massive move. Really, they're trending to the downside. In fact, there's more shares that went down than went up. Again, internally, that is not a good sign. That goes to show that the market's kind of like going on fumes now. Nasdaq total volume, even though if it's on the upside, the volume has been actually lower. It's been kind of getting lower. In other words, less market participation, especially from the big boys, because they're the ones to move the market up, right, or market down. The more the participation, the more of a truer market, let's say, environment, or truer representation of market strength or weakness, right? That's a truer value. Um, so then we look at the number, not Amex. Let's see. There you go. NYSE, the total number of volume of shares that went up or went down based on the volume. Again, you look at it, it's kind of this is actually looking nicer than some of the previous data we saw. But if you look at, let's say, okay, yesterday market went up, right? It's really just going up gangbusters, right? Um, and the reason I'm using NYSE is because that's the biggest exchange, um, right? But if you look at the number of shares that yesterday went up, it was kind of it's actually to the negative, right? It's going down. In other words, more shares went down than up in volume terms. And you can also see that on this up move, there's just simply less stocks that are going up volume wise, and kind of trending down, right? Um, yeah, so these are all basically some of the those are some of the market internals that I thought was interesting to see because it goes to show that as the market's moving up, they're kind of losing losing momentum or internal cohesion, internal strength of that move. Now, back to something also again you can see on the total volume of SPX, right? As the market's moving up, the volume has been going down, which again goes to that's basically shows like weakening strength because again less market participation and who's participating in it are basically mom and pops. Like if you look at on this day, which is the 12th of August, which was Friday, market really went up, but the volume in fact went down. The previous day, where there's more selling, um, which goes to show the people who are moving it up is going to be more so people with less volume or less buying power. That's again mom and pops, right? The weekend, so to speak. Um, what was I gonna look? So basically, those are some of the. Let's see what else. Uh, oh yeah, this one also is kind of interesting to look at. This is actually something again internal that we should be looking at. Is the difference between um, the difference between new highs and new lows for SPX or S&P 500. You can see that the number of like new lows, even though the market's been going up, the number of new highs versus new lows, it's not really ratcheting it up because that means that most of them are still in the down, that they're still lower than um, they may be off their lows, but they haven't really gone to and started making new highs, right? At least enough numbers to start to inch it up. That implies again that still a bear market environment, right? And we don't have a divergence. Um, I mean, in this case, the convergence because we have a divergence because the market is going up, yet we're still at zero. In other words, the number of shares that are going making new 52-week lows of highs isn't keeping tabs with the stock market going up. Again, they're not converging. These two trends are not converging, and this is acting as a divergence. So, which goes to show that again we are in a bearish environment. Um, so yeah, so basically, you can see like for in this down movement, how many stocks were to the making new lows, 52-week low versus 52-week high on those days, right? Correspondingly, we're not seeing any kind of improvement like that, except the opposite direction. So what all this means is that basically at this point, given where the market's at, technically speaking, it almost is, now it's like a very crucial spot that we find ourselves with the market. And if our basis is right, remember that we are in summer. Our summer, we were expecting a summer rally. We have gotten it. In fact, we've gotten a much better rally, bigger rally than I would have expected, or at least my expectation was. Um, Primarily because since the last leg is basically based on like hope. I mean, I don't want to use this kind of word in like when I look at the market, but it's based off of like expectation of future events based off of some like offhanded comment by Powell, and since they've been trying to retract it by having all the Fed guys go out there and say no, 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 why? Because well, it's their intention is to keep on hiking. That hasn't really gone away. The intention is to, uh, you know, uh, create more financial tight conditions. That hasn't really gone away, right? Look at SPY. That's something also interesting to look at. Um, let's take a look. Take that off. Okay. What's interesting to look at SPY is, I mean, it obviously acts in a similar way to the underlying market, but what's interesting is you look at the volume. the volume is kind of tapering off as it's moving to the upside, and the average volume is kind of coming down. Why is SPY important? Because as someone who's been a trader in the institutional space, um, when we're speaking of market participants, big participants like hedge funds, um, private funds, public funds, your 401k, your retirement funds, all these people, right? They use SPY as a proxy for the market because SPY is many ways it's like the basis for the market. I mean, it's unthinkable how important, not unthinkable. I mean, it's very, yeah, I guess unthinkable how important SPY is to the overall market and overall, like investing in general is because this forms the basis of like entire portfolios because this is a way for you to gain exposure to the overall market, right? And to basically balance, let's say, certain portfolio, which is essentially how most, markets, most market participants use them. Um, for example, if I buy ETF instead of buying like bunch of stocks, I can just buy SPY ETF and make that the, like let's say, basis of my portfolio. If I have, let's say, 60/40 type of uh, regular like passively managed account. So it's important because you can see that we should be seeing more volume as it moves up because like I said, the more volume, the more market participation, the more of a truer representation of the price that you're seeing. And something again is interesting is as it keeps on moving up, the volume kind of is kind of coming down, which is acting as a divergence. One. Number two, also remember summer's almost over here. Like people are going back to school, so traders will be coming in. And September, and like I said before, like July is like one of the better months, or one of the best months, I believe. And I said before, like July usually we should expect some kind of a up move. People sell in May and go away. The traders sell in May and go away for summer. So now people are going to be coming back, and usually somewhere between August and November, pandemonium happens, right? Um, and what's interesting to think about is that September is a really bad month. Now, all of a sudden, like technically speaking, we're seeing, like market internals kind of getting weaker as it moves up on this bear market rally. Um, Now it's going to be about 2 months long. Usually lasts about 6 weeks to 12 weeks or so. 12 weeks is kind of like stretching it, but generally speaking, about like 6 to 8 weeks or so. We're going to September. We have kind of like over kind of euphoric type of expectation going into Fed's action in the future. We have technically speaking some of the things that we saw, like again, it's kind of like weakening as the market's moving up. Um, so a lot of things are happening that's basically um, kind of a maybe giving another sign that we might be headed down if the market you know um, doesn't break this level, right? Because that's again a strong signal that that's going to be a strong signal. So, and this is also everything's converging. Again, this is how many times I've done these kind of videos where we see market move off of like pivot levels or these kind of important inflection points where many things happen, many things kind of converge and come together at the same time. If it does break, I mean, technically speaking, it does do damage to our underlying immediate, trade direction, immediate to like intermediate, direction, um, and it has to repair that. Um, it has to repair that price action, start to move down again in order for our bias to start moving down and go, like prove our bias right again, right? So if it does keep on moving up and breaks above this level, Yeah, I mean, technically we're going in a sideways market, and for it to come down, make it, go back into main trend of the bear market, it has to then repair the downside price action, right? And then we have to make new lows to get to the bear market again, which is breaking through 60 or so to 3600. But my point though is that this is still a overall bear market, underlying bear market environment. Our technicals are kind of getting tired here. We're expecting like inflection points, given that our basis is that we are still in a bear market. We should expect to see a rejection here. Um, I mean, there's a lot of other things I can add, and to be honest with you, I've forgotten. So, housing market is kind of going, kind of headed down. Like you can see, new housing starts fall to 17-month low, which generally leads the overall economy and the market. Because again, this goes to show that on a lower underlying basis that there's simply less consumption, and there's less liquidity. There's less people participating in buying high-end items. There's less money going around, right? So this is something I've gone over before, where the housing market has been breaking down slowly for some time, and that's something to keep an eye on. Um, and the next leg will be, on this bear market, if our um, biases gets to be proven right. I mean, like I said, we've gone over a few different things why we still think that it's a bear market. One of those things that's going to be more that are going to be kicking that in is going to be the failing housing market. It's just that it got overbid. Now we might be seeing some of the liquidity coming out of it, with that tapering off, more volatility into the housing market, which would should also lead into failing you know equities market. So I don't want to keep on going on. So it's been what 37 minutes. So I'll let that go for now, and I hope you guys have a great day, great week, happy, awesome time trading. Um, yeah, I mean, good luck with everything. Oh, by the way, this is not an advice. It's just one man's look in the market. Really, that's really it. I'm not recommending you to do anything. You should do your own research to find out what is best for you, or someone you trust. Go to like a advisor, something like that. Um, but yeah, I'm not an advi. Well, I mean, I have licenses, but I'm not advising. This is not like I'm not telling you to do anything. So that's it. Yeah, I hope you guys have a great day, and talk to you guys later. And I think I have missed a few points that I was gonna make, but I think I've made enough for now. Um, so I probably should like get like a bullet point type of deal where we like have some things to like point out, step by step, rather than like go off the cuff and just like regurgitate whatever's in my head. Which, to be honest, it's just that it's not organized like on a piece of paper, but it is what it is. So anyway, guys, hope to do one of these later again, and let's see where the market takes us. And yeah, hope you guys have a great day and great week, and good luck trading.